Welcome to the latest Hardman Talks on Chesnara. I'm financial analyst Brian Moretta, and today we're joined by Chesnara's Chief Executive, Steve Murray, and CFO, Tom Howard, to discuss the recent interim results. We will start with Steve and Tom giving a short presentation, which we will follow with a Q&A. Steve?
Thanks very much, Brian, and good to be talking to you all. I just wanted to give an overview of the half-year results. I'll then hand over to Tom, who'll take you through the numbers in more detail, and then I'll finish at the end talking about some of the areas that we're focused on as a group, including M&A. So overall, it's been another good set of results for Chesnara. We've seen strong cash generation. We've seen a strong solvency balance sheet. We've seen good organic operating earnings as well. And we've also increased our dividend by 3% for 20 years. That uninterrupted dividend track record, we believe we're one of only 7 companies across the main UK indices and European indices that's achieved that track record. So we're very proud of that. On this slide, we're setting out what you should continue to expect from Chesnara. So we continue to have multiple levers that are available to us to grow the value of the company, and that value should ultimately turn into cash. And you've seen that come through from Chesnara over the last 20 years very, very consistently, and that supported great dividends back to shareholders. We're fortunate to have a strong balance sheet. That's proved to be very, very resilient through a number of market conditions, and it also provides us with lots of headroom when we think about strategic opportunities such as M&A. M&A has been a core part of the strategy here at Chesnara since we were formed as a listed company back in 2004. We've completed 4 deals in the last couple of years, and we're positive about the outlook for future M&A. And finally, we believe we've got an experienced management team and board that's focused on creating sustainable shareholder value. So that's what we believe you should expect from Chesnara going forward. So I'll hand over to Tom, who'll talk through the results in a bit more detail.
Thanks, Steve. What we're showing here, and I talked a little bit about this at a recent results presentation, is just moving to a slightly simpler way of looking at the financial performance of Chesnara. So we're looking at this, or we look at this through 3 lenses: our cash performance, the strength of our balance sheet, and then our outlook for future value generation. So looking to the cash results, we reported commercial cash generation of 29 million, and that was significantly ahead of the first half of last year. That was helped in part by strong economics over the first half of 24, but also pleasingly positive cash generation from each of our operating divisions. From a solvency and capital perspective, the Solvency II ratio of 201% sits comfortably above the operating range of 140 to 160% that we tend to work to on a longer term basis. And what that means is that we have a significant buffer over our capital requirements that we can use to invest back into the businesses, but also to fund future M&A. And I think the other pleasing aspect of the capital position is the fact that the ratio of 201% has remained broadly above 200% over the last 12 months. So it's able to withstand short and longer term changes in the macro environment. And then when we look to future value generation, this is a really critical part of the performance lens for us as a management team. So Steve made mention of the dividend track record over the last 20 years. And one of the things we look at very, very closely is our ability to follow up that 20-year track record and replicate that well into the future. And the things we look at to make that assessment are ECV position and our IFRS capital base. So over the period, our ECV earnings increased by 20 million, and the IFRS capital base remained robust at 458 million. And that suggests to us and indicates to us that we have strong sources of recurring future value to fund future dividend payments, but also future investment strategy. And I'll come to how we think about that in a little bit more detail in a moment. So when you bring all of that together for the half year, that supports the decision we've made to increase the dividend by 3%. And I think actually this slide here speaks for itself. So I talked a moment ago about the resilience of capital position. What we've actually managed to do as a group is increase the dividend over 20 years. And through that 20 years, we've actually seen quite a lot of volatility. We've lived through the global financial crisis. We've had COVID. We had the impact of the UK budget pretty recently and what that did to UK gilt rates. And actually, we've managed to produce that steady return to shareholders despite those pressures. And we do expect to be in a position to do that going forwards. So I talked a moment ago about those future sources of value and why they're so important. And at the presentation a couple of weeks ago, I did feel it was important to set this out and to just give people a sense of why we feel that these sources of value are reasonably predictable and certainly factor into our thinking when we're thinking about future capital allocation and investment decisions. So there are really three sources of what I call structural value creation as the book moves forward. So the first is, I'll move from left to right, we have the risk margin and SCR release. And that's basically the release of capital that we hold against the in-force book. So as the in-force book runs off, we have to hold less capital. That capital is released to the balance sheet. And ultimately, we have the ability to distribute that via cash or to reinvest that cash back into the business. The second is real-world investment returns. So when we think about the projected value of the business, and when we use measures like ECV and own funds, we use quite prudent assumptions around future investment returns. And part of the skill that we employ within the organization is to actually invest our assets in a way that generates in excess of risk-free, but also our policyholder assets will, over the longer term, generate returns in excess of risk-free for our policyholders, and we also benefit from that. So that is, again, a very predictable and recurring source of future value for us. And then the third block are management actions. So management actions are actions that we as a management team take from time to time to optimize either the liability side of the balance sheet or the asset side of the balance sheet, or actually the capital position of the firm itself. So these range from activities like reinsurance, things we've done in the past, like foreign exchange, hedging, mass lapse reinsurance. On the asset side, it involves things like increasing the risk profile of the assets where it makes sense. And I think it's important to note that we actually didn't employ any management actions over the first half of this year. So we actually managed to generate the improved cash result, maintain a strong solvency position without actually taking any opportunities to optimize the asset or liability side of the balance sheet. So those actions remain open to us, and certainly something that we'll be exploring over the second half of this year and beyond. So when you take the three sources of value together, what that does is it suggests that there is a cash or a value generation opportunity over the medium to long term. And that actually comfortably exceeds our planned, our projected dividend payments, debt servicing costs, and other costs within the group over that period. And this is something we actually use in our internal planning and in discussions we have with the board around capital allocation and capital planning. Now, the other important aspect of value as well is M&A. And M&A is actually obviously core to our strategy. So M&A in and of itself is another source of value. So when we bring portfolios onto the in-force book, what we can do is benefit immediately from capital synergies, expense synergies, and then on an ongoing basis, we can use those synergies to further improve the cash profile of the firm. So that's yet another source of value that we have at our disposal going forwards. So when you put all of that together, what that does is it really creates a predictable pattern of future value that we can use to really support the cash profile of the firm from, as I say, from the medium right into the long term.
Thanks for that, Tom. So I thought it was useful to remind viewers of the three things that we focus on here at Chesnara strategically. So firstly, we focus on running the books of business that we have as well as we can. We have nearly 1 million customers across Europe and the UK who rely on us for their pension business, their protection, their wealth products, and their savings products as well. And if we don't do that well, we have no right to execute other parts of the strategy. And when I look at what we've done in the half year, we've made further progress around implementing the UK target operating model, working with SS&C. We've transitioned staff to them, and we're working very, very hard to complete the migrations that we need to move to that single target operating model. With the Canada Life book expected to transition at the beginning of 2025, and the remaining books that are in scope expected to transition towards the end of 2025 and at the beginning of 2026. And there's more that we can do to either accelerate cash from those books of business or to take actions that can increase value. And that can be things like expenses, that can be reinsurance, and that can be broader restructuring for those books of business. As Tom and I have both touched on already, a key part of our strategy is M&A. We're continuing to see good opportunities to execute M&A in our market, and I'll come on to that in a little bit more detail in a second. And the third area of strategic focus is the writing of new business, which we do in a focused way, providing we can be comfortable that we can make the right return on capital and then we can make a profit. We've seen more new business coming through from Movestic than we did last year, which is a positive trend in that marketplace. One of the new features of Chesnara over the last 18 months has been the fact that now we write a small amount of new business in the UK. That's through an onshore bond product that we acquired through the Sanlam acquisition, and that's contributing around about £1 million a year of value of new business, which is a useful add-on to the economic value of the group. And then we also write new business in Skilden. We write term insurance business through brokers, and that's been lower than we've seen in previous years due to market forces being more competitive, but overall the term market being a little bit lower as house sales have also been lower compared to historic levels as well. But we continue to see new business as an opportunity to top the value up of the group. But in terms of where the material area of growth is likely to come from Chesnara, we continue to expect that to be from M&A. So let's then move on and talk about M&A. The key drivers for M&A activity for us have sort of remained the same over the last 12 months or so. And the top three areas we're seeing as the most important. So we still see global insurers trying to simplify their operations, deal with legacy technology, announcing outsourcing platform issues. They're taking the opportunity potentially to look at non-core books of business and recycle the capital that they hold against those products and use them against other things. For example, in the UK, deploying that capital onto bulk purchase annuities, where we now see around 13 major insurers participating in that relatively new part of the market. And then finally, we're seeing large global insurers refocusing their focus on geographies, having planted flags across the globe over the last 20 to 30 years. And what we like about those trends is they're less reliant on the macro environment than other things. These are strategic reasons that people are dealing with issues, and we expect those to continue going forward. And an overall trend that we've been seeing in the M&A market is insurers, rather than thinking that they have to sell an entire legal entity and all of the portfolios of business and all of the products that are in there, we're seeing insurers taking slices of products that are less core to them and seeing if they can hand them to acquirers or potentially offload that risk to reinsurers. And we like that trend because we have 3 operating platforms, 3 geographies that we operate in, 3 sets of regulatory licenses, and there's a narrower field of people that are able to take those portfolios because they need to immediately go onto somebody else's operating platform. And that, along with the key strengths that you see on the right-hand side, gives us a lot of confidence in our ability to execute M&A. And we've had a busy first half to the year. We haven't actually executed an opportunity in the period, but we have been active on a number of files. And for us to believe that we're going to be successful, we need to have a number of opportunities coming into the top of the hopper, and also believe that we've got the ability to then execute those. And we believe both those things continue to be true. And particularly when we map our pipeline forward, we're seeing good opportunities both in the short and medium term. One of the key considerations for us as well is how we finance M&A, particularly as we're seeing some larger opportunities in our pipeline versus maybe 2 or 3 years ago. So this slide attempts to set out some of the things that we think about when we're looking at financing M&A. On the top left-hand side are some of the key considerations and potential constraints for us. So Tom talked about the normal operating range for our solvency position being 140 to 160%. And when we think about doing acquisitions, we want to continue to operate within that range. And we have plenty solvency headroom today in Chesnara to enable that. Secondly, our investment grade rating from Fitch that we got when we issued our tier 2 debt a couple of years ago remains important. So if we were raising debt as part of any transaction, we'd need to have confidence that ultimately any debt that added to the leverage ratio could be repaid, and ultimately we could bring the leverage ratio back down to around 30%. And we also want to hold cash reserves that will cover about a year's worth of dividend, a year's worth of debt coupon, and also working capital requirements for the group as well. And the PLC cash position at the half year again has remained strong. We're forecasting cash being just under about the £140 million level, which again gives ample headroom. So when we look at that together with the PLC overdraft facility that were renewed again this year, that means we have readily available firepower of at least 200 million before we have to go externally and raise more debt or even consider asking shareholders for more money. So that means, again, that we believe we're in a strong position to go forward and execute M&A, not least that 200 million represents about half the market cap of Chesnara when I'm presenting to you this afternoon. So finally, when I think about Chesnara, what can you expect from us going forward? But I also think it's worth us reminding you some of the things that we've been doing over the last 3 years. So the bottom grey layer here, these are some of the foundations that we've been putting in place at Chesnara to enable us to push the strategy forward and grow the organization. So we have taken steps to simplify the investor story. We've increased the financial firepower that we have. We've strengthened the leadership team, including the recent hire of Tom, who you're seeing today. And we've been far more proactive when it comes to M&A. And we're starting to see the fruits of some of that labor really appear. So what's that resulted in? Well, we've added at least 50 million of ECV to the group from the transactions that we've executed. You're continuing to see strong cash generation coming through. This unrivaled track record in European insurance of 20 years of uninterrupted dividend growth. And we're now seeing a more positive pipeline than certainly I've seen over the last 3 years. Going forward, what can you expect from us? Well, we are planning to do more value-adding M&A, but also ensure that we make sure that we get the full value from the M&A that we've done already. One of the key areas of focus that Tom will have is ensuring that we're even more proactive with capital allocation and that we also look at the investments that we have to better optimize the returns that are available. And that should have a positive impact on our cash generation. I believe there's more things that we can do to drive more value from the constituent parts of the group. And one of the things that we're trying to do also is to simplify the financial metrics that we use to speak to investors to make us even more attractive to a broader range of potential investors in the stock. So overall, I believe there's a lot to look forward to here at Chesnara. It's been another strong set of results. We're positive on the M&A pipeline, and yet again we've announced an increase in the interim dividend for the 20th year in our history. So with that, Brian, I'll hand back to you maybe, and we can start the Q&A.
Great, thanks very much, Steve and Tom. I think you finished on M&A. I think we'll maybe just keep going on the M&A sort of topic in the questions. So having listened to you for a few years now, when discussing acquisitions, though, you've talked very much about the speed of earning cash, and that seems to have been a significant part of the thinking. If I listen to you now, you seem to be thinking more in terms of long-term cash generation than getting it back quickly. Can you discuss the reasons behind this change in emphasis?
Yeah, it was interesting when I first joined, and I was doing my initial engagement with investors and also the analysts that cover stock and other stakeholders. One of the things that seemed to be a concern where people were saying, you've got this great dividend track record, we've seen the cash coming through, but we're worried that sort of it's going to stop within the next year. So one of the things that I wanted to do was sort of satisfy myself that we could see that cash generation continue to come through. And Tom's talked through that today in terms of the slides. But in many ways, then making sure that initial M&A that we were focused on as we were trying to invigorate that machine, we were tending to focus on things that recycled that capital a little bit more quickly. And you've certainly seen that from the deals that we've done. One of the focuses that Tom and I are looking at the moment is whilst we won't turn our noses up at all at deals like that will recycle the cash, we think there are opportunities, particularly where you've got books of business that have got very long-term liabilities, to potentially acquire those books that add cash, not just in the next sort of 5 to 10 years, but add cash in the 10, 15, 20-year time horizon. And we think that should be really attractive for investors, because actually you really then are talking about, a very long-term, sustainable, progressive dividend policy that gets enabled as part of that as well. So I think that's why you've seen a little bit of a change in emphasis and certainly talking about that so that investors understand how we're thinking about these opportunities. And it's not at all that we're saying we don't like opportunities that have those shorter paybacks, but we think there are good opportunities to add to the long-term cash generation of the group as well. Of course, that has to be at the right price and with the right sort of risk profile as well.
Yeah. Yeah, obviously. So it's now been over a year since you last had an announcement of a new deal. I know you've been up to stuff. Can you give us a flavor of what you've been up to in that period, and perhaps what's been the barriers to completing more transactions?
Yeah, so we've looked at a broad range of things. I mean, it really has been a busy period for us. Hopefully, investors can take a little bit of comfort from the fact that whilst we're busy, we don't feel like we need to do a deal every half year. You know, it's important we retain our discipline. If we look at the sort of size of things that we've been working on, we've been continuing to work on the sorts of sizes of deals that people have seen from Chesnara before, but there have been some larger opportunities as well. And I think, Brian, when we spoke alongside the full year results, we were talking about probably seeing a broader range of potential deal sizes in that pipeline, and things that were certainly well over the sort of 150 million of consideration mark. And that's proved to be the case in terms of what we've been looking at. And in terms of the sorts of books of business, so that's been across both the UK and Netherlands. We have been having conversations in Sweden, but probably they're a little bit less progressed. And we've looked at unit-linked books. We have looked at some books with longer-term liabilities as well. So there's been a pretty broad spread. What stopped some of those deals from happening? So one of the situations that we looked at, we got a long way through due diligence. We were negotiating legals, and ultimately the sellers' priorities changed. So they were looking at what was important for them strategically. And for a bunch of reasons, it didn't make sense for them to sort of proceed with the opportunity that we were working on. That happens from time to time. Myself and Tom have both worked in very large insurance companies, and part of the challenge for us is going to be trying to make sure that some of the opportunities that are large for us but are small for the big companies sort of remain on the priority list. So there was nothing within that was really anything to do with our ability to do that transaction. It just became less of a priority. A couple of the other opportunities, what we try and do up front in these transactions is get enough information that we can put a very well thought through offer to a counterparty and sort of agree that up front. And then what you're doing through DD is you're trying to prove the assumptions that you stated when you sort of shook hands at that high level on a sort of deal. And sometimes those assumptions, when you look at them in DD, are different. And part of the reason for that is if you're taking a small slice out of a large insurance company, quite often the assumptions are set at a global level for that larger insurance vehicle. And if you take a portfolio out for that particular book of business that can be, 1 to 5% of the total policies, the assumptions for that sliver can be quite different to the global assumption, and that can lead to either a value gap or a contractual ask from us that can't be bridged. And we have seen situations where that's happened as well. Our activity in the first half has given us more confidence that there's nothing within our model that we're seeing as a huge barrier. There's nothing from a sort of macro environment perspective that we see as a barrier as well, Brian. So we'll continue to be sort of persistent and diligent and looking at things and making sure that if we do execute deals, that they create great value for shareholders. And I think we've done that pretty well over the last 2 or 3 years.
Yeah. Well, we all hope the stars start to align again soon for you. Turning to sort of capital and cash, over the last sort of couple of years, you sort of highlighted the scope for further management actions to sort of release capital, improve cash situations. You didn't do anything the first half. We had a very good economic backdrop. And I wonder if you want to maybe talk about to what extent a positive economic backdrop alleviates or offsets the need for these sort of management actions and thinking about the sort of prospects in the next sort of year or two.
Yeah, shall I take that? I mean, I think on management actions generally, Brian, we actually don't feel the need as such to push the button on those, as a matter of course. So what we tend to do is be more judicious in terms of when is most opportune to take the opportunity, basically, to do those at a fair price. So if you look at things like reinsurance options, because our solvency position is in such a strong position, we actually don't really have to go out and use things like reinsurance or take asset re-risking options to shore up the balance sheet. So as a result, what we can do is actually step back and wait until some decent deals come up in the market. And what we saw towards the end of last year actually was we had quite a mixed second half of the year in terms of macro. Q3 was quite poor, Q4 was better. But actually, we came through that. We delivered strongly on cash, and we had a strong solvency position. So that actually set us up very, very strongly for 2024. And when you look at it through that sort of longer term lens, where you're running at a kind of a 40% plus surplus over the top of your solvency operating ratio, there's actually no need to sort of go and chase some of these management action opportunities. So when I think about management actions, I'm very much thinking about them with a 3 to 5 year or even beyond timeline. Very, very happy to wait until the right ones present themselves to actually fit the bill in that context. And that actually really informs the decision as to why we didn't take the option to, as I say, to push the button on any of those in the first half. If you see us taking some actions in the second half, it would be because there's just a really, really good opportunity to do that. As I say, whether that's through, preferential pricing on the reinsurance side, whether it's through an interesting asset opportunity, perhaps we'll do that. But look, we don't feel the need to do that. And I think we're in this nice position where actually the macro backdrop doesn't have a huge impact on timing.
Mm-hmm. Yeah. No, that's comforting. Can I turn to operations now? And I think perhaps the disappointing item was in the first half was a return to higher lapses than assumptions in Sweden. In your results, you mentioned efforts to retain customers. Maybe you can talk a little about what you're doing to that to retain customers, and you're also hoping for stability. And and I guess after what's happened the last few years, I think to what extent can we have some confidence that that's going to appear in the near future?
Sure, it's probably worth us reminding people, Brian, just to what's happening in that market. So what we're seeing is in relation to the sort of workplace pension products that we run and we sell in that market. We have seen increased outflows from that business. A few years ago, what we're seeing was some quite aggressive pricing in the market that we decided not to match. So over 50% of the transfers out in the market were going to one participant. So we've seen that dynamic go away, but we have overall seen, whilst we saw lapses come down initially, we've seen them go back up a little bit, and they are above the long-term assumption that we use within the valuation of the business, which is why you've seen that strengthening of the reserves in the first half. Some of the things that we're doing. So look, firstly, you've seen stronger sales momentum from us. So we're bringing policies into the top of the company. And if we look at both the unit-linked sales that we have combined with the custodian sales that we have as well, the overall sort of net client cash flows that we see coming into Movestic are positive. That said, the business that's coming from the unit-linked back book is higher margin than what's coming in, which is why you see that overall sort of value loss in the start of the period. The sort of things then that the team are doing to help sort of mitigate some of those outflows. So firstly, we've actually got a retention unit within the business. We're using propensity modeling and things like that to try and predict when people might be considering leaving us, and that can lead to engagement either with the broker that's responsible for the customer or with the customer themselves, particularly where we're seeing sort of valuable features on a plan that we think customers may not be aware of. And we've got a reasonable rate of success around that, albeit the net impact is a loss of value there. What we've also been doing is engaging with some of the broker firms, because it's interesting actually. The people that lead the broker firms would far rather that the brokers are out writing new business rather than moving existing books around the market. So we've been able to share with them some data and some insight from what we're seeing in relation to those brokers, perhaps to help them with their centralized processes. And we have seen some positive impact from that as well. And we've also been looking at both the existing products that we have, but potentially some developments that might mean our overall suite's a little bit more attractive as well, and it can help us sort of retain that business. So I think we're seeing some positive evidence that those things are working. That said, if transfers out remain at the level, I wouldn't expect those retention activities to fully offset the impact of those higher rates. And ultimately, one of the things that we're expecting is that we'll see that trend back to perhaps not the levels that they were historically, but a lower rate than they are just now. And there's a lot of industry sort of conversation around the rates. It's certainly not just impacting us; it's impacting all the insurance companies that are operating in this market. So.
Mm-hmm. Yeah, and churn, we know, is something that, I know from my experience in the UK. UK wrestled with this for a little while ago as well. So I know it's something that maybe we might see some regulatory thing at some point. I don't know.
Yeah, no, that can be. I mean, you saw that happen very materially in the UK with the introduction of the RDR, which I think the regulators were just getting very worried with practices, but the amount of value has been taken out the value train in terms of commission. So I certainly wouldn't rule out some sort of regulatory intervention as well.
Yeah. So, Tom, you mentioned trying to sort of simplify the presentation of sort of Chesnara's results, and this is something I have sympathy with. And I remember when I started to, sort of cover Chesnara, it took me a little while to get my head around all the sort of bits and what's moving. Do you want to maybe give us a couple of thoughts about what you're sort of looking at to do that?
Yeah, I mean, look, like any insurer, that a lot of things happen under the bonnet, and there is a lot of complexity in the balance sheet. But we have a lot of very, very skilled people who make that look easy. So actually, part of my job then is to take that and with Steve, find an easy way to tell the story. And I think, as an industry, actually, we've not been fantastic at doing this generally. And I think one of the things I've observed, and certainly one of the things I've heard from our investors, is a real appetite for us to actually articulate the real story via the metrics. Because the real story here is that we have a business which is very efficient, which is very strongly capitalized, and which generates lots of cash, and that's ultimately the story, and it's compelling. So I think what we need to do, or certainly what I feel we need to do, is just review the suite of metrics that we have to explain the financial performance of the business, and just align them a little bit more to that view. Just the strength of the balance sheet, excuse me, and the cash profile. Mm-hmm. So what you should expect to see, and I hope actually you got some sense of how we presented the half year numbers, was a small first step towards doing that, where actually we focused on a slightly smaller number of metrics to tell that story. I think we'll take the opportunity just to review that further, particularly as we go into the full year, because I think what that does is, A, it helps with the story, but also B, it helps with the comparability. So for people like you and others who analyze the stock, it's just much easier, I think, then to be able to compare and contrast our performance with some of our peers in the market.
Mm-hmm. Yeah. No, that does make sense. So thank you very much, Steve and Tom. If you want to read more about Chesnara, you can look at the recent note on the interim results, which will appear is on our website, along with all of our other reports on Chesnara. If you want to get future Hardman Talks videos, you can just hit the subscribe button next to this video. Otherwise, thank you very much for listening, and we look forward to being back with you in the near future.